Welcome back. We're almost at 9 o'clock. This is Open Exchange, and we are coming to you live from the CNBC-TV18 Motilal Oswal studios. Well, we'll start getting the pre-open rates in the next couple of seconds. Before we get to that, let's welcome in our technical experts as well. Mitesh Thakkar as well as Shrikant Chauhan are with us this morning. Gentlemen, happy Friday to both of you. And now the tough questions. Shrikant, what have you been doing in this market? Have you managed to sell these bounces? And what would your approach be today? Because the expectation is we'll start with another big bounce.
Good morning, Survi. I think, one thing is very clear that the market recovered sharply from the important crucial levels. And the recovery was very clearly in terms of if we see the candlestick pattern or technical formation, then it's a reversal pattern. I think markets are heading for minimum 17,250 to 300 levels. And if we see today, the market is sustaining above the mark of 17,100, then we can expect market to move towards 17,300. At least at this point of time, we should not be seller. But yes, if we see the market is very close to 17,250, 300, there certainly we should look for taking some short positions.
Mitesh, you were a little circumspect yesterday about the pullback, and that pullback got sold into as well. There is a gap up today. Do you chase it or do you wait again for a better entry point?
Good morning. So yesterday, actually, we were saying that don't short it out. There could be a pullback, though I think we're not sure of a reversal as yet. I think that stance still continues. The idea is that you are in a situation wherein the markets are extremely oversold. They're hitting important support levels, but we hadn't got a signal of reversal on the intraday hourly or the 2-hourly chart. So I think that is where the wait and watch kind of a mode came into play. And that remains the near-term outlook. And basically, I think, while today we get a gap up and we are expecting this markets to possibly rally to about levels of 17,150 to begin with. And in the best case scenario, as Shrikant was highlighting, 17,280, 300 zones is what I'm looking at. I think only beyond that we get some kind of a significant reversal. Till then, it will only be a pullback rally, a rally which will be a throwback from oversold levels. But that's totally fine. I think you can still play with stocks in that kind of situation. Stocks which are reversing from extremely oversold levels give you a good trading opportunity, a good risk reward entry equation for a 3 to 4 day kind of trading positions.
Okay, gentlemen, good morning. Mitesh, in terms of specific trades, what do you have?
So, morning, Prashant. I have all buy calls today. Couple of crude related items again. They've been on the agenda yesterday as well. HPCL is a buy with a stop at 238 for a first target of 255. And Asian Paints, disclaimer, we have some futures positions here. Asian Paints is a buy with a stop below 2865 for a target of around 2955. That apart, Aurobindo Pharma is a buy. I think Nimesh also highlighted the stock yesterday. That's a buy with a stop at 464, targets of 495. And Power Grid, again, disclaimer, it's part of my long-term portfolio. That's a buy with a stop at 228.5 for a trading rally to about 240 levels.
Shrikant, what about you?
Yeah, Prashant, good morning. Bajaj Finserv is certainly looking good. It is forming double bottom sort of formation close to 1250, 1260 levels. From there, it is rebounding. So we can expect 1360, 1370 on the head side. We can keep stop loss somewhere close to 1260. So Bajaj Financial Services is a buy. Also, we like L&T Infotech, which is currently trading around 4,500 levels. There also we are expecting stock to move towards 4750, 4775. And finally, we are expecting some short covering in metal companies. And in that space, we like Tata Steel, which is currently around 105. There we are expecting 110. We can keep stop loss somewhere close to 103.5.
All right, Shrikant and Mitesh, thanks a lot for joining in. Let's also welcome Hemang Jani from Motilal Oswal, as well as Prabal Sen, who's the energy analyst at ICICI Securities, joining in. Thanks a lot, gentlemen, for joining in. Hemang, also thank you for patiently waiting by. Just wanted your thoughts on the way things are poised in the market right now. We have a lot of cues. What do you think is the best strategy?
Correction across the index as well as the broader market. I think we are poised for some sort of a pullback because incrementally news are turning positive, both in terms of crude as well as in terms of interest rates. So I think it would be good to kind of go out and look out for some bounce back across banks, the way crude has fallen, I think cement and some of the beneficiary of the lower crude oil, maybe some of the paint companies, tire companies, that should see a good amount of pullback. And lastly, we are in the dividend season. So we have come out with a 4 to 5 stock basket where we are looking at a 6 to 8% kind of a dividend payout in companies like IOC, Nalco, GAIL, NTPC, so on and so forth. So I think it would be good to kind of poise for participation with some sort of a short-term positive bias.
Okay, all right, Hemang, stay on. We have more questions for you. Prabal Sen is also with us. Prabal, great to have you on the show. Good morning and happy Friday to you. So first, just a quick top-down view. This fall that we've seen in crude oil prices, I mean, that's obviously making everybody sit up and take notice because it's a pretty substantial one. We don't know if it's going to last or whether there's a quick bounce, but for the time being, how do you distill this down to some of the large listed companies, whether it's the refiners like Reliance or BPCL, IOC on one side or an ONGC? Let's start with the refiners. What immediate impact do you see on GRMs, if at all?
There are two sides to this for the Indian players. One is obviously, as you said, refining. We have seen that spreads have pulled back a little bit, specifically in gasoline spreads have pulled back a bit. Diesel spreads have also cooled off a little bit because obviously when this crude decline is being actually led by concerns on demand rather than any supply issues. And that's important to remember that GRM start to get impacted when demand-led concerns actually lead to a decline in crude. And that is something that we are seeing happening. So for GRMs, it's obviously a little bit of a negative. Having said that, the decline has been more from the January levels to March. If we look at average Singapore GRMs, they are still sustaining at close to $7. This is in comparison to about 5.9, I believe, was the average for Q3. So on a QOQ level, while there has been a decline on a month-on-month basis, the overall trend is still marginally positive. Diesel spreads and gasoline spreads being a little bit off hurts the Indian refiners a bit more because the weightage of those two products is obviously the highest for most Indian refiners. On the other side, this decline is extremely positive for the OMC's marketing business. We know that price hikes have been held up for a fairly long time, and now finally, despite no changes in prices, what is now happening is that retail margins have actually improved substantially from a blended level of around, I think, 1.6 rupees of losses in the last quarter. We are now trending at more than 3.5 rupees of net positive margins on the transportation fuel, which is petrol and diesel. So to that extent, and that is something that you are seeing reflecting in the way OMCs have behaved, because the strength of the marketing segment is something that always drives stocks for OMCs much more than whatever is happening in refining. So that's on the downstream space, the way we see it.
So, Prabal, just to follow up, what you're saying is really interesting. For at least IOC, BPCL, HPCL, is this event then net neutral? Because they're making up on the marketing side what perhaps they're losing on the spread side with the refining margins coming under some pressure. So net-net, is it neutral for the stocks?
For IOCL and BPCL, perhaps not, because the refining to marketing ratio for IOCL and BPCL is a bit higher. IOCL is almost at about 0.9 refining throughput to marketing volumes. So for them, the refining loss is a marginal negative as of now. For HPCL, clearly it's a positive because the over-dependence on marketing, which hurt them earlier when the losses were higher and even though GRMs were performing very well, now that completely turns around. And our sense is that the net impact, if you only look at petrol and diesel, the marketing impact versus the impact of what has happened to spreads. For HPCL, it's still a net positive. For IOCL and BPCL, it's a marginal negative as of now. Obviously, that can keep changing if GRMs normalize. But as of now, I would say that it's a marginal negative on the margins front.
Okay, got that. We'll leave it there. Thanks very much, Prabal. Appreciate you joining in and running us through what you're making of things. So quick conversation there with Prabal on what's happening with oil prices and the consequent impact on oil marketing companies and, of course, on Reliance Industries as well. So let's just have the SGX up for a quick bid. And I'm not sure if you have the graphics with us, but the pre-open is up about 0.75%, 126 points higher. So this is a good start. Now, we had Danielle in the morning with us who was basically talking to us about, she mentioned a couple of figures. She basically said that this was data released after US market hours, which shows some caution, which would warrant some caution. So I decided to kind of just look into this. So basically there are two data points which you need to know. The number one is on your screen. The total AUM of money market funds, the highest quality government money market funds, latest data shows, weekly data, it's jumped by $121 billion in 1 week. This is the largest weekly increase since April of 2020. That is point number one. Basically, it shows that investors are retreating out of what they perceive as being risky, maybe equities and other things, into the highest quality money market funds. This is the largest increase, as I said, since April 2020. Of course, the depths of the COVID crisis and things were pretty bad then. So you would say this is very stark. And the second one is that withdrawals from, the Feds, from the US Federal Reserve, via two windows. One is the newly announced window after this SVB crisis and the discount window, which has always been there. And this is also weekly data. It's topped $160 billion, which is the highest we've seen in some years. This, again, basically shows you that, in a way, banks are battening down the hatches and getting prepared for whatever volatility and the uncertain times which they think lays in front of them. So Danielle kind of put this up and said, well, she mentioned this figure, the second figure actually, and she said that it kind of shows sort of risk aversion and caution. It does, but I would argue and say that this is all coming after what has already happened over the last 2 weeks or so, and things seem to be on a bit of a thaw. Of course, things can change on a dime, as she also pointed out earlier, but I think both these data points important to take note of as we continue to track market movements over the next couple of hours or so. We are close to market opening with 4 minutes to go for the open. The pre-open, of course, is indicative of a good higher start. Nimish is here with the standard brokerage reports that he's picking up and what should be in focus. Nimish, over to you.
Hi, Prashant. So today's standard is on Indian IT companies. Morgan Stanley has put out a big note, and they've made some changes to their preferences. Now, they have upgraded two stocks, which is Cyient and L&T Mindtree, to overweight, and they've downgraded two stocks, Tech Mahindra after the recent up move, and Emphasis to equal weight from overweight. Now, let me talk about the overweights first. A double upgrade on Cyient to overweight from underweight, and they've sharply raised the target price there to 1100 from 730 earlier on Cyient. And on L&T Mindtree, they have upgraded to overweight, and they've raised the target price there to 5600 versus 4600 earlier. Now, the key reason is they believe they see more tailwinds than headwinds, and that will lead to higher margins for the Indian IT companies. And within that, they prefer the likes of L&T Mindtree, TCS, and HCL Tech as the best preferred plays because they are positioned for margin levers compared to the peers. So, a big changes in the Indian IT names, but a double upgrade on Cyient and a big upgrade on L&T Mindtree from Morgan Stanley today.
All right, an interesting note out there, a big upgrade on IT stocks coming in from Morgan Stanley, the standout brokerage report of the day, as Nimesh points out. But the other stock, let's revisit NTPC. Vivek, good news coming in for NTPC. Tell us more details once again.
Well, absolutely. Reports are indicating that the bids for the monetization of the green portfolio has been finalized. Malaysia's Petronas is set to be leading the race. And remember, just for some background, NTPC is looking to monetize its renewables portfolio. Equity value, as per media reports, of the 20% of NTPC's green energy portfolio is coming in close to 3,800 crore, which values the total arm at close to 19,000 crore. Now, remember, NTPC's green energy actually has 2.9 gigawatt renewable energy capacity already operational and 4.7 gigawatts under construction. Now, what Jeffries is saying is that this implies 12.5 rupees per share accretive value as far as NTPC's share price is concerned if this deal does go through.
All right, Vivek, got that. Thanks very much. So NTPC is definitely going to be a stock in focus. The pre-open has been in sync with the SGX Nifty, actually absolutely in sync. 120 points up is the kind of pop that we are expecting. And what's interesting is that the screen is looking uniformly green today, whichever index you're picking up, including the Bank Nifty, which has been the biggest culprit from a bull's point of view. Nifty Bank should open with a gap up of about 0.8%. So a lot of those stocks are up and about. Infosys, TCS, interestingly, are higher in trade. Let's just pull up TCS for a
TCS
final
is down
check.
1%.
Exactly. So, I mean, it's a very simplistic trade, I think, right now, that the pre-open is suggesting that you sell TCS and buy the others today. But I don't know, Prashant, I mean, life is rarely as simple and linear as this, right? If only making money was that simple.
It was just a few days ago that we were talking about Infosys, some senior leadership leaving from Infosys
And
as
going
well
to Tech
join
Mahindra. Yeah.
Tech M and so
and that was that day straight. Tech Mahindra was up
exactly.
and Infosys was
so
down.
It's all over the place.
But you know, this open is, I think, is reasonable. I mean, 1% lower because yesterday there was some saying there's going to be a deep gap down. I said, well, it could be, sure, but there's and maybe this transition period, the stock perhaps underperforms as Morgan, etc., are putting out. But it's a deep leadership as we've been kind of talking about. Let's just quickly have the market rates coming up on your screen. 17,122 is where we are at on the Nifty. The Sensex is starting in a pretty solid way as well. The Nifty Bank is up 1%. The mid-cap index is up about 0.9%. It's uniformly green all across. And let's just hope that what we've seen now for the last many sessions, which is trying to sell the bounce straight away, does that happen, or there is a bit of a stronger fight back this morning? Nifty IT is up about 0.9% as well. Nifty Pharma is up. It's a broader market. I mean, it's not as if one pack of stocks got sort of beaten down or anything. The broader market took a big knock, especially on the Nifty, and there is a broad-based recovery which is underway and lasting so far so good. Between 0.5% and 1.25% gain on most indices right now.
Yep. Okay, and that linear trade for the time being is really playing itself out because you do have Infosys, HCL Tech, these stocks on the upside, and straight away TCS is down. Last I checked was down about 1% or so. It had just opened out marginally in the negative. It's paired off that cut. But TCS is flattening out, which is what we were just saying that that's too simplistic a view to take that you sell TCS and buy Infosys today. If that's how it plays out. There are already buyers sort of queuing up at lower levels over there. In any case, some of the other movers and shakers on the upside include Dr. Reddy's. Some of the metal stocks like Tata Steel and Hindalco are bouncing back. They were sold off big time yesterday. And then you have the banks, Kotak Mahindra Bank, Axis Bank. Let's see what ICICI and HDFC are doing. Up 0.5%. HDFC Bank is up about 1%. So it's a good-looking screen. Just beyond the indices, some of the stocks that are immediately catching the eye. Glenmark, remember, Ekta was just telling us that the US FDA has approved trials for one of its new drug applications. So that's a pop of about 5%. And then some of these, stocks where there are, hopes of contracts coming in, whether it's a Bharat Forge or some of the others as well. That's what's playing out. And Manglam, for the timing, the market's really holding. I mean, it's a solid 1% move. And for the timing, it's all green.
Yes, 150 and holding on the Nifty as we speak. 17,150 is where we are at right now. The mid-cap index is a much better looking screen this morning. You have nearly 7 stocks advancing for every stock which is declining. And talking about some of the gainers, you spoke about potential contract winners, the defense stocks. That is the theme of the day. We have a big gain coming by on Hindustan Aeronautics, up 4.5%. Bharat Forge is the other one, which is sitting with a gain of about 3.5%. Seeing some profit taking on Z somehow after a big move that it saw in the second half yesterday. Z's opened about 2.5% lower, continues to see some more sell-off. And FMCG is seeing some bit of profit taking as well. And this after a flight to defense that took place yesterday. So Godrej Consumer down by about 0.75%, Colgate down about 0.5%. Berger Paints too is not particularly good this morning. But the other pack which is also doing well is the mid-cap IT space. Nimesh spoke about a couple of these mid-cap IT names in his standout brokerage report. So LTI Mindtree up 3%. We have a big move on Persistent Systems as well, up 2%. So by and large, it is a much better looking screen at in the mid-cap end of things. And the Nifty Bank too, outperforming with a gain of 1%.
I mean, it's a good-looking screen, isn't it? Let's just hope it lasts.
Yes.
It lasts, right? As I was saying, I mean, people, naturally, with the amount of volatility we've had, it makes sense to watch the market for a little while and then kind of try to get in. The reversal, the absolute, not absolute, but the reversal level for me is still about 100 points away, 17,220. We're at about 17,120 right now. So let's see, 140, 130 points higher. That's the market at this point for you. More stocks in just a bit from now. But Rahul Arora is with us, Chief Executive Officer at Nirmal Bang Institutional Equities. Rahul, great to have you with us here. Thank you very much. It's been a week which feels like a lifetime. It's those kind of markets, right? What are you making of things right now?
Morning, Prashant. Thanks for having me. I guess that's what they say in the market. It's a week is a lifetime. But I think there are two or three things, Prashant. One is, of course, what you were discussing about SVB and what's happening with the US banking system. I think, interestingly, the ECB hiked by 50 basis points yesterday. And Switzerland is considered to be a very integral part of the European Union. That, as a pretext, I think the Fed may still go ahead with a rate hike when they meet next week. So our base case is at least 25. I think if you looked at the last inflation print in the US, it was at 6%. And overnight, if you took a look at the housing start numbers, they've grown by 10% and the building permits are up by 14. This is concerning because 55% of the US inflation is housing. So you can kill demand, as opposed to India, which the only reason you're hiking rates is to counter the carry trade, because 55% of your inflation is fruits and vegetables, which is a supply side issue. So my sense is it's going to be a challenging year. I think the very broad range is probably going to be 16 to 18,000, but with a downward bias. So keep eyes on the global scenario. But I think probably another 50 at best from the Fed and maybe another 25 from the RBI, and we're done. The bigger story is going to be the economic impact of these rising interest rates. And what we've seen in the US in the last 1 week may just be the beginning of that slowdown/recession that we've been talking about. So I think when we were talking around Diwali, we were expecting the first half to be bad and the second half to be good. That was a general consensus, even from global broking houses. I think that trade is sort of reversed. I think the first half is seemingly okay, but I think it's going to get a little more challenging as we go along. So I think cautiously optimistic, as Infosys always says after its results, but I think with a slightly lower bias is my sense.
Okay, so it's interesting that you're going back to that cliche that we love and hate with equal vigor, right? Cautiously optimistic. But Rahul, now what you said sort of for a minute made me feel that that translates into 16,800. October lows pretty much holding for this market. But then you suddenly moved on to say that watch out for the second half. So what's the market prognosis given this entire context? And what are you advising? Should people be putting in money right now, wait, keep some cash because you get much better levels?
So, Surabhi, nobody really buys the market. You always buy stocks, right? So that 5-digit number is purely an academic number because there will be stocks at a 7,000-8,000 Nifty also that are expensive, and there'll be stocks at an 18,000 Nifty also that will be cheap. There is value that's definitely emerged, and if the Nifty was to grind lower, see, when the Nifty started grinding lower, it's changing its range by 500 points every now and then, right? It started off with a broad range of 17.5 to 18.5, then that became 17 to 18, it's now 16.5 to 17.5. So it's progressively grinding a bit lower, and that's a bit disconcerting. From an economic standpoint, I think we're at about a 6% GDP growth with a slightly, lower bias, so to speak, for next year. But I think if you've read the data points on DLF overnight, they've sold about, apartments worth $1 billion in 3 days. So I think the K-shaped recovery that people are talking about is today more pronounced than ever, I think, because everyone is moving their portfolios away from mass to premium, right? Whether it's two-wheelers or whether it's consumer discretionary versus staples or so on and so forth. So I think given the fact that we're in a pre-election year, I think a lot of onus is going to lie on the government of India. The fact that Madam Finance Minister has spoken about a 33% increase in capital allocation, and a bulk of that is going to go to roads. So I think that's one sector where we be overweight. Stocks like PNC, Infra, KNR, Construction. As a second order beneficiary, I think cement will do well.
Right.
I think we're looking at an 8-10% kind of volume growth. And I think as a tertiary benefit, if you have a good monsoon also, which generates employment, I think consumption could probably make a comeback. So I think that's probably one bucket at play. And maybe commercial vehicles and chemicals. I think this is where the sectoral allocation would be if I was making a portfolio today.
Well, Rahul, you've been tracking the consumption space for a very long time, and you said that a tertiary benefit could come to the consumption names. Just wanted to understand your thoughts, how you position on that space right now, in light of the big management changes that have happened. Colgate has Prabha, then you have Sudhir Sitapati at Godrej Consumer, and recently the announcement coming in from the big boy HUL.
So I think these are well-oiled machines.
Yeah.
I think, unless you have someone that really comes and messes things up, and these are homebred names, right? And you could extend that to an HDFC Bank or a TCS or an Infosys or whatever. I think these are such well-oiled machines where I think unless something goes dramatically wrong, I think the growth will continue. I think the macros will probably dictate. I think from an allocation perspective, I think most FMCG companies in India have broadly 35 to 55% of their sales coming in from rural. I think that's where the incremental delta is going to come from because, if you analyze lever over the last decade, it's compounded its top line by only about 8.5%. It's because the margins went from 15 to 25% and your earnings compounded by 17, 18%, that the stock went from 300 to 3,000. Do I see that visibility for the next decade? It's very tough to get a 10% margin expansion on these. So you need volume growth to come back. My hunch right now would still be a little bit more on consumer discretionary than it would be to consumer staples. But like I was telling Surbi, I think if you do have a good monsoon and these projects do get announced and it results in employment, my tilt would probably still be towards Lever and Britannia. I think those would be the top two staples I'd play. And from the discretionary side, I'll play something like an Indian Hotels, which is a leader in its pack, maybe a Westlife in the QSR space. Yeah, I think more than that would be too much of consumption at this point, but that's probably how I would structure.
But you're positive back again on Indian Hotels because you
no, so I think this is going to be a good year. I think beyond this year is going to be a challenge. You're moving into an IPL in a couple of weeks. On the other side of the monsoon, you have the Cricket World Cup here. So I think this year should be okay. But to give an exit multiple is going to be tough because at 350, 400, Indian Hotels goes to about 25 times EV/EBITDA. I would probably buy a Westlife today as opposed to an Indian Hotels. But I think Indian Hotels for the next 1 year, Westlife, I think, is probably a more compounding story over 5 years. I think this stock could potentially double from here, is my sense.
You've been a big bull on Westlife for as long as I can remember. Yes, Rahul, we know that. Just to follow up on consumption, and Mangalam and I were discussing this on our digital show yesterday because we're trying to piece things together. Yesterday, Maruti comes and tells us that, purchasing power is getting hit because of higher inflation, cost of ownership, and, so on and so forth. So they are seeing a visible reduction in inquiries, the rush to go out and book. That's a statement from Maruti. So when we're talking discretionary, on the other side, you are seeing what you're seeing with DLF. Now, that's premium end, obviously. How do we put the pieces of the puzzle together to figure out what part of consumer is the safest to play in an environment where things will get challenging, but the second half, as you say, could be perhaps worse off than the first?
I think this holds true across the board, Surbi. I think if you extend it into two-wheelers, I think Eicher is doing better than TVS, Bajaj and Hero at this point in time, and so on and so forth. So I think, okay, so let me put it this way, right? So you probably had a period of about 15 months where people sat at home, give or take. And you probably saved a certain amount of money in that 15 months, whether you saved 3 lakhs, 5 lakhs, 10 lakhs, whatever.
So you had the revenge purchase, travel,
yes,
all of
and
that.
I still don't believe we've seen all of it yet, right? It could have resulted in staycations within your own city. It could have resulted in, inter-India travel, intra-India travel, overseas. Anything could have happened. I still think that there is still that amount of money that's still there to be deployed, but I think that wealth effect at some point will wane. So, which is what I was telling Mangalam earlier. I think I would still be positioned heavily on any segment that is offering you premium, regardless of the sector. I think on a lighter note, even something like a cement, if you hear their conference calls, even they talk about premium cement and the kind of, sales that they're seeing. So I think that the P word, so to speak, is gaining a lot more traction than the M word, which is the mass word. I'll give you a case in point. We, met the management of V-Mart Retail somewhere in December. They get, I think they have about 70% of their stores in UP, Bihar and Jharkhand. Very few companies will give you a pulse of the rural market like V-Mart Retail would. Bang in the middle of winter, a company that's situated in Delhi and does its sales in these markets, volumes were down 30%. Right. You were in the middle of wedding season, you were in the midst of winter. So this is probably going to take a while to reverse itself. And that's why people, you'll find most managements. I mean, just to go back to a point on Lever, right? The last analyst meet they had, Sanjeev spent a lot of time talking about the fact that 1/3 of Lever sales are now through premium. And Lever would never historically talk about that because they want to be seen as a mass market brand. So I think that's changing, and I think your portfolios need to align themselves to that effect.
So 7 crore houses and,
but I wanted to say that
2 crore cars.
But the 7 crore, I mean, sure. I mean, the top end is doing very well, but that's also to do with the budget, tax changes, etc., right? I mean, a bulk of it would be driven by that. So I'm not sure how much of that one should read across as, the top end also doing so phenomenally well. I mean, it's been doing well, absolutely.
No, I take your point, but I think if you just go back and annualize the sales that people have been doing, let's take the Bangalore market, since you guys were discussing IT. Look at the sales that Brigade, Shobha and Prestige have been doing at the premium end. And I think this is across the board. I think Oberoi, I really don't think somebody from the Bajaj family has gone and bought a 250 crore 3-story house just because he's got a tax cut. So I think there is demand. That's obviously an aberration. Yeah. But I think even prior to that, the point I was making on Eicher, I think the sales have been consistently good quarter after quarter. So I take your point that this could be an added lever, but I think there is still that wealth effect that's playing itself out that will probably keep the volume growth sustained for a slightly more protracted period of time, is my sense.
Okay, Rahul, thanks very much. Great to speak with you. Appreciate you joining in with that perspective. Thanks indeed. Well, the market is holding on with about 135 odd point sort of pop. We're at about 17,122. Holding on, so far so good. Our next guest is someone who's seen global markets very closely for a long period of time. Dan Feynman is co-head of equity strategy Asia Pacific at Credit Suisse, and he's joining us right now. Dan, great to have you with us here. Thank you very much for your time. You know, you are in more ways than one at the center of things in terms of being able to see what's going on around you. So tell us, are things thawing a little bit, or you know, the uncertainty in terms of what happens in terms of financial dislocation still remains very, very high? What's your sense?
Well, I think that any time you see as big a rise in interest rates as we've had over the past year, there's the potential for accidents to happen. I wouldn't, however, say that the current episode is going to lead to a systemic crisis. The banking jitters that we've seen so far are largely idiosyncratic. And more importantly, central banks and regulators have learned a lot since the global financial crisis in 2008. They know that you need to step in with large liquidity injections early, and that can prevent a crisis from appearing.
Dan, I'm tempted to ask what the conversations would be in the corridors of your own office, because you know, Credit Suisse also has been at the epicenter.
Well, as I say, we are confident that regulators and central banks have matters in hand. I think it's important to keep in mind that we don't have a credit quality issue in any of the banks that are facing pressures right now. There's a big difference between a situation where banks have big NPLs and where there are solvency questions, and what we've got right now, which is basically a liquidity problem. Central banks can deal with liquidity problems much more easily than they can deal with NPL and solvency issues.
Dan, you know, one argument that I heard over the last 48 hours or so, and it seems to be a very logical argument, that right now this is perhaps an asset liability mismatch issue that's playing out across different banks because of the space of, you know, interest rate hikes that we've seen. But quite a few commentators feel that perhaps a couple of months down the line, it could start becoming a credit quality issue as we get this hard landing or soft landing in the US, and in general, growth slows down around the world. That could be a very serious scenario, but do you see that playing out?
I don't think so. If you look at household leverage, it's quite a bit lower, particularly in the US, than it was on the eve of the global financial crisis in 2008. We're expecting a recession in the US, but not a deep recession. We think it'll be a fairly shallow, a fairly short-lived recession. It will likely be a recession that leads to earnings problems at banks, but not a systemic issue.
So what's the, okay, so in you know, given how things stand right now, what is the equity call for Asia Pacific, and specifically a market like India, which in any case, even before these global worries, you know, we were dealing with a lot of money moving out of here into our neighboring market, China?
Well, I think the call is that Asia is a better place to be than the US or Europe right now. We have more robust economies. Cyclically, the economies are better positioned. We don't have the same inflation problem. You haven't had the big run-up in rates and bond yields that are causing some stresses in Western financial systems right now. India is a place that I think looks quite safe right now. We're not entirely happy with the valuations, but the macroeconomic backdrop is quite stable.
So if you had to allocate some assets, you know, between, say, gold, debt, equity, and inequity, you have developed markets, emerging markets. In emerging markets, you have India, China. How would you, you know, distribute a fresh $100 check?
Well, we're roughly neutral between fixed income and equities as asset classes as a whole. But within equities, I think you can do better than fixed income in Asia and in emerging markets. We have a big overweight in global emerging markets within equities. And I think you can make money in absolute terms this year, which probably won't be the case for US equities.
Mangalam, just to rephrase that question, you should have asked, you get a $100 check, would you wait to put all of it in India, or would you put it in right away? I would have thought.
He's still with us. What are your thoughts?
Dan, are you there?
Yeah. Yes. So we would be roughly at benchmark in India.
Got it.
But within an Asian portfolio, within a global portfolio, we would be overweight.
All right. Now, got that. Okay, let's just pull back a little bit to global again. After market hours, we had some data which I think this is data from, with regards to borrowing from the Fed, which has topped about $160 billion. This is weekly data from the Fed. Another data point which some are talking about is that inflows into money market funds in the US is basically the highest level, again, the weekly data, at the highest level since April of 2020. How would you read both these? Clearly shows risk aversion. The question is, can you use this data to interpret what comes next in a positive or negative way? Go on.
Well, I think the positive angle is that it will probably avert a crisis. The negative angle for some players would be that for mid and small banks, that they're probably going to have to pay a deposit premium to be able to attract depositors to put money with their banks as opposed to the bigger banks that are perceived as being safer.
Dan, just to press that point on India slightly further, care to give us some more color into, as you do allocate more, if you do, what pockets would you target? And is valuation your prime criteria? You'd only look at pockets where you feel valuations are right? Or would you look at, let's say, safety, play the Indian consumer? How are you strategizing on this?
I certainly wouldn't be relying purely on valuations. I'd say the key issue is to focus on domestic India over international India, over exporters of goods or services. So banks, consumer, which are exposed to domestic India, those would be the places I would focus on.
All right, Dan, great to speak with you. Thank you very much for your time, and hope to speak with you again soon. Let's hope things settle down. I think in the best interest of everyone. I mean, the financial markets and, of course, the real economy as well. We'll take a very quick commercial break here. We've got the market, which has come off already. We're about 88 points higher. So I'll just quickly look at what the day's high is. The day's high stands at 17,145, which means now we're about 70-80 points off the high point of the day already. 0.5% on the Nifty still there. We'll come back and we'll speak with the management of Samvardhana Motherson International, who will talk to us about their selling of 3.5% stake by Sumitomo Wiring Systems. Later, we'll also connect with Kiran Mazumdar-Shaw of Biocon and Biocon Biologics to talk about trends in the biosimilar space and their business outlook. Stay tuned.